We're going to start chapter 11 now, which is property dispositions. So we're talking about selling or trading, somehow disposing of property and the rate at which the gain would be taxed. Everything we're looking at in this chapter is from the perspective of the business. So we'll think about the consequences for the individual taxpayer, but our focus is on what is happening from the perspective of the business, and we're thinking about the owners of the business. So when we're thinking about what a disposition is, we're getting rid of an asset. To determine the gain or loss, we have to know the amount realized. And I think about the amount realized as what we get. So we have to know the amount realized and the adjusted basis. All right, so the amount realized is the cash that you get, the fair market value of any other property you receive. If you're relieved of liabilities, those are all things that you get. I had my debts relieved, I got cash, and they gave me a piece of machinery in exchange for something. What did we get is all of these components. We're able to subtract any selling expenses that we have. So our amount realized is what we would normally call the proceeds from the sale. Anything you receive minus anything that you're giving up. All right, we've talked about the adjusted basis before, but again, the adjusted basis is the initial basis as we defined it in chapter 10. What did we pay for something, including any installation, taxes, things like that, minus any cost recovery that is allowed. So that would be accumulated depreciation plus any 179 expense. So we've got our amount realized and our adjusted basis. That tells us our realized gain or loss. Okay, so our realized gain or loss is the amount realized, what did you get, minus the adjusted basis. All right, the realized gain typically is the same amount that you recognize. So I'm going to say typically the same as what is recognized. So when I was learning about this, I remember my professor saying that realized gain or loss is what's really happening in the real world. What's really happening in the real world. And the recognized gain or loss is what we have to consider for tax purposes. So recognized means the tax implications. All right, so recognized gains or losses are gains or losses that increase the taxpayer's gross income, which means the taxpayer must report these gains or losses on the tax return. So recognized is our way to describe we have to do something for tax purposes. There are tax implications. Realized means this is what's really happening. I'm getting rid of something. I had a basis in it. What do I get? What did I give up? That's what realized means. And then recognized means that we have some implications on our tax return. So here's an example. Eric bought land 5 years ago for $6,000 cash, a $30,000 loan, $1,500 in legal fees, and $500 in real estate commissions. On July 1st, he sells the land to Dane. Dane pays Eric, I'm going to get a different color for this one, $12,000 and assumes Eric's debt of $30,000. Eric pays $1,000 of legal fees and $2,500 of real estate commissions. What is Eric's gain or loss on the sale? So I have to come back, and to figure out the gain or the loss, to figure out the realized gain or loss, I have to know the amount realized minus the adjusted basis. So I'm going to calculate those two things. Let's do the basis first. So Eric's basis he paid $6,000 in cash. He also had to assume $30,000 in debt. He had $1,500 in legal fees to purchase this land, and he also had to pay $500 in real estate commission. So his total basis in the land is $38,000. We don't depreciate land, so there's no cost recovery that's going to affect our basis. So now we just need to figure out what is the amount realized. So amount realized equals, let's go back and look. Dane pays Eric $12,000. So Eric is getting $12,000 cash. Eric's also getting $30,000 in debt relief. So $30,000 in debt relief. Then Eric pays $1,000 of legal fees. So we're going to subtract that from what he gets. And he also pays $2,500 of real estate commissions. So when we think about what Eric ends up getting at the end of it, he gets $38,500. Then to calculate the realized gain, it's what did we get? $38,500, it's our amount realized, minus our adjusted basis of $38,000. We have a realized gain of $500. So step one is understanding what is the realized gain or loss. And once we know that, we can then move forward and start talking about the character of the gain or the loss. Now, we care a lot about character in tax. Character is what determines the rate at which the gain will be taxed. So it's not enough to know that we have that $500 gain. We need to know, well, what type of gain is it? So the rate at which the gain will be taxed, and I'm going to add, and the type of income the loss can reduce or offset. The character of the gain depends on the character of the asset. So if it's an asset that we're using in our trade or business, that would be different than an asset we're holding for investment purposes. So the character of the gain depends on the character of the asset. The character of the asset depends on how the taxpayer used the asset. So how the taxpayer used the asset. So your book uses an example of a piece of land, And the piece of land would be a capital asset for someone who's holding it for investment purposes. But if you're a realtor, then it would be considered your inventory and it would not be considered a capital asset. So depending on how the taxpayer used the asset, that determines what type of asset that it is. This table is from your textbook, and it's a really helpful table to understand how we think about these assets. So property use, how is the taxpayer using the asset? Assets that are used in a trade or business, if they're held for 1 year or less, are considered ordinary. If they're held for more than 1 year, they're considered Section 1231 assets that we'll talk more about later. If they're used for investment purposes or for personal use. If you've held them for less than a year, they're short-term capital. If they're held for more than a year, they're long-term capital. And then finally, if you have inventory or accounts receivable, those are considered ordinary. So I would take a few minutes and get comfortable going through this table and kind of looking at the types of assets. It's really helpful, and it will help you in the future if you really kind of have this down and can figure out what type of use it is, what type of asset we would then consider it. All right, so let's talk a little bit more about ordinary assets. Ordinary assets, we have here, here, and here, are assets created or used in a taxpayer's trade or business. So the example we're giving is inventory and accounts receivable, which we see over here, or machinery and equipment owned for 1 year or less. So that's where the short-term distinction comes in. When we have ordinary gains, they're taxed at ordinary rates using our tax table, the normal tax bracket. Ordinary losses are deducted against ordinary income. So we would be able to offset our ordinary income with those ordinary losses. Then when I think about capital assets, so capital assets we've talked a little bit about before, but they're assets that are held for investment, for the production of income, or for personal use. Okay, and there are a couple of notes that I want to make here. So when it says for the production of income, this does not mean for a trade or business. So that's kind of confusing. So it's not for a trade or business. It's something that doesn't rise to the level of a trade or business, because if it was a trade or business, then it would be an ordinary asset. So you won't see this one as much, but this might be something that you do as a hobby or something like that, where your goal is to produce some income, but it's not really going to rise to the level of being considered a trade or business. So what we see most here for capital assets are assets that are held for investment or personal use assets. The really important distinction that I need you to get here, I'm going to actually highlight it in red, is that personal use losses are not deductible. Okay, so we have this default that personal use assets are capital assets, but personal use losses are not deductible. So when you buy your car and you drive it for a couple of years and it's losing value and you go and sell it and you have a loss on your car, that doesn't go on your tax return anywhere. When you buy furniture and you use it at your house for a while and then you decide you don't like it anymore and you want to sell it, you sell the furniture and you have a loss on the furniture. Not deductible because it's for personal use items. Okay? It's a really important distinction that I want you to know, and it will come back many times, and I see students struggle with that component quite a bit. So gains on the sale of capital assets can be used to offset losses, and net long-term capital gains are taxed at a preferential rate. We've done this before. We've calculated how to calculate tax for preferred items and for ordinary items, so we're just going to get into the details a little bit more now. And then there's no special capital gain treatment for corporations. So when we're thinking about our capital gains, we're thinking about investment or personal use. They can be short-term or long-term, depending on how long we've held them. All right, losses on the sale of capital assets. Remember, we talked more about this, or we talked about this in, I don't know, maybe chapter 5 or 6. And we said that individuals can deduct net capital losses up to $3,000. We're going to get more into this in chapter 7. But right now, I want you thinking about, we're going to net capital gains and losses together, and we can deduct the net capital loss up to $3,000. And then corporations cannot deduct net capital losses against ordinary income. They are doing a carryback of 3 years and a carry forward of 5 years. All right, our next distinction that I want to talk to you about is Section 1231 assets. These are assets that are used in a trade or business with a holding period of more than 1 year. So if we go back, we're talking about these assets right here. They're used in a trade or business, and they've been held for more than 1 year. So just to give you a little bit of background, Section 1231 started during World War II. And when war was hurting the economy, the government started this classification of 1231 assets to encourage the investment. So I'll say to encourage businesses to invest in new assets. So we're hoping to stimulate the economy, and we'll talk about how this would happen as we keep going. So potential 1231 assets are things like land, depreciable real property, tangible personal property, and intangible property. All of those items could be considered 1231 assets. And what was special about them and why they helped stimulate the economy is the tax treatment of these 1231 assets. So taxpayers combine 1231 gains and losses from multiple assets. If you end up with a net loss, it's treated as an ordinary loss. If you have a net gain, it would be treated as a long-term capital gain. So I want to point out that these are really good things for the business. Would you rather have an ordinary deduction or a capital deduction? You'd rather have ordinary because it offsets ordinary income. So I'm going to say good because it can offset ordinary income. And then I'm going to say for number 3, if you have the gain and you get to treat it as a long-term capital gain, that's good because it will be taxed at a preferential rate. So you're kind of getting the best of both worlds here. When you net those 1231 assets together at the end of the year, you have some gains, some losses, and you net them together. If you end up with a loss, you treat it as an ordinary loss. If you end up with a gain, you treat it as a capital gain. And this is to the taxpayer's benefit because those are the best case scenarios for those two items. So here's an example of what I mean. Let's use blue. Theodore sells the following assets from his business during the year. We have land with a gain of 40, a machine with a gain of 15, computer with a gain of 1, building with a loss of 20, and office furniture with a gain of 3. Assuming all of these assets have been held for more than 1 year, that has to be true or they wouldn't be considered 1231 assets. What is the net Section 1231 gain or loss? Then, how much tax will Theodore, a single taxpayer, owe on these transactions, assuming his taxable income is $250,000 in total? So the 1231 netting process. So we have $40,000 in a gain. We have a $15,000 gain and a $1,000 gain. Then we have a loss of 20. Oops. And then another gain of 3. So we net those all together and we have $39,000 and we would say this is a net 1231 gain. So we're in that category where we have a net section 1231 gain, and because it's a net 1231 gain, it gets capital gain treatment. So capital gain treatment means it gets to be taxed at the preferential rate. And the preferential rate for this taxpayer is going to be 15%. So the tax owed will be $5,850. And you might just want to note here, this is a preferred rate. The ordinary rate for this taxpayer with income of $250,000 is not going to be 15%. If this gain was taxed at ordinary rates, then the taxpayer would pay much more in tax. All right, so I want to tell you about another possible scenario that happens here and that has created a new rule. So you know that our tax rules are complex because we have situations where people take advantage of the rules, right? They try to push the rules to the absolute limit. So what this taxpayer would want to do ideally is to take this loss of $20,000 and have that go to 1 year. I'm just going to say year A, and then have all of these gains go to year B. Because if I did it that way, if I was able to push the gains all in 1 year and the losses all in another year, then I would get this preferred capital gain treatment on all of my gains, and I would get to offset my ordinary income with this $20,000 loss. That is what taxpayers were trying to do, and that would be the most preferred outcome, except that you're not allowed to do that. And so there's a new rule that came into play to prevent taxpayers from doing this. You can't have all your gains in 1 year and your losses in another year and get the best of both worlds. So what we're going to flip to next is called the 1231 look-back rule. Okay, so the 1231 look-back rule only applies to 1231 gains, and it's designed to prevent taxpayers from trying to time these gains and losses into years with only other gains or only other losses. So it's designed to require taxpayers to recognize gains in the current year. And if you've taken that ordinary loss deduction because you've had a 1231 loss before, then we're going to require that you recharacterize the gain as ordinary income. So here's what I'm trying to say. If in 2019 I recognize a loss, and then I get ordinary loss treatment on that, because we can see that when you have net losses, they're treated as ordinary losses, and I get to offset ordinary income. And I'm happy about that because offsetting ordinary income is really beneficial to me. So in 2019, I have a loss. And then in 2020, I have a gain. And I'm happy about that because my gain is going to be treated as a long-term capital gain, and it's going to be taxed at a preferential rate. The 1231 look-back rule says, well, if you have a gain in this year, you need to look back and see if you've had any losses that offset ordinary income in the prior 5 years. And if you have taken that benefit and offset your ordinary income with these losses, then some of the gain that you have now is not going to get capital gain treatment. It is going to be, we call it recaptured or recharacterized as ordinary. All right, so if there's any net 1231 loss in the previous 5 years that has not been recharacterized, then you treat the net 1231 gain as ordinary income to the extent of those losses. You go back 5 years first. You start way back 5 years and then work closer and closer. If you have any remaining 1231 gain, then it will be treated as a capital gain. All right, so here's the example that I want to go through. So we have True Tiger has the following net 1231 gains and losses. So in 2014, there was a gain that would have gotten capital gain treatment. In 2015, there was a loss. That would have gotten ordinary loss treatment. It would have offset ordinary income. 2016, there was a loss. That would have also been an ordinary loss. 2017, there's a gain. That would have gotten capital gain treatment. 2018, there's a loss. That would have gotten ordinary loss treatment. And then finally in 2019, there was a $30,000 gain that would have gotten capital gain treatment. So what the 12-year look-back rule tells us is when you have a gain, you need to look back and see if you've taken any losses that would be ordinary losses in the last 5 years. So we're going to first look in 2014. And in 2014, we have, I'm going to say ordinary and then 1231. In 2014, we had a $12,000 gain. So I'm going to put it over here in this 1231 category. Then in 2015, we have a $6,000 loss. And the $6,000 loss would have been an ordinary loss. And so I would have deducted it against my ordinary income. In 2016, I have the same situation happen again. I have a $25,000 loss. I would have offset it against my ordinary income, which would be good for me, and I would go on my merry way. Now 2017 happens, and in 2017, I have a net 1231 gain of $16,000. And this is where the look back comes in. I have to look back, and normally the default rule would be that I would get capital gain treatment on that 16. But the look back rule says, well, if you've gotten the benefit of ordinary loss deductions in the past 5 years, some or all of the $16,000 will not get capital gain treatment, and it will have to be considered ordinary. Okay, so in 2017, I'm going to use a different color and say, yeah, because I had losses that I considered ordinary in 2015, $6,000 of my 16 has to be reclassified as ordinary. And then I also had losses of 25 in 2016 that I had ordinary treatment on. So the last 10 is also going to have to be considered ordinary. So that $6,000 has been recaptured. The $25,000, 10 of it has been recaptured. There's 15 still considered a net capital loss that has not been recaptured. So this gain of 16 that happens in 2017 is, even though it's a 1231 gain, and even though the default rule is that that should get long-term capital gain treatment, it's not going to because of the 1231 look-back rule. It has to be recharacterized. I'm going to say recaptured as ordinary because I've taken this benefit in previous years. Okay, I'm going to move on then to year 2018. In 2018, I have an $8,000 loss. It's an ordinary loss. That's fine. I just keep going. Then I have 2019. And in 2019, I have a $30,000 net 1231 gain. And so I have to go through that process again. And I say to myself, is any of that gain going to need to be reclassified as ordinary? The default rule is that the gain should get capital gain treatment. But I have this look back rule that says if you've gotten the benefit of losses against ordinary income in the last 5 years, then some or all of your gain will have to be reclassified as ordinary. I'm still going to have a $30,000 gain. The question is, how much of it is going to be get the preferential tax rate and how much of it is going to get ordinary tax rates. So I look back and I go back as far as I can. So I'm going back to this 15. So 15,000 is going to have to be recaptured because I had that loss in 2016. Now all of that year's losses have been recaptured. I'm going to go back now to 2018, and I have 8,000 in losses that I took. So 23,000 has to be reclassified as ordinary. The 8,000 has now been recaptured. 7,000 will remain with capital gain treatment. So again, I still have $30,000 of a gain. The question is, how do I tax that gain? I normally would get to tax it as a long-term capital gain and I get preferred tax treatment. But because I've taken these losses previously, I have to recharacterize, or we call it in tax, recapture. I have to recapture to the extent that I had losses in the last 5 years that I took as ordinary. So we would say 23,000 is recaptured as ordinary income. 7,000 here would get capital gain treatment. So is a 1231 asset a good thing or a bad thing? It's a good thing for reasons that we said above, that you normally get ordinary loss treatment on losses and capital gain treatment on gains. That's the best of both worlds. But because taxpayers were timing these sales so that they'd have all their losses in one year and be able to offset them against ordinary income, and all of their gains in another year and get capital gain treatment, we now have the 1231 look back rule, which makes it difficult for firms to do that timing. That's where they would have to recapture as ordinary income any gains to the extent that they had losses that offset ordinary income in the prior 5 years.